Morning, everybody. How we doing? Morning, Evil, GM, Church, Gregors. How's everybody? There's not many in here this morning. Everyone is asleep this morning. I'm on at the right time, aren't I? I think I am. I don't know. Still adjusting from holiday. Morning, Virginia. So let's have a quick look at what's going on today. Let me just quickly... What's going on with the indices? They just opened. DAX, short break on the DAX, but looks like it wants to go long. FTSE's broken short. So yesterday on the indices, just before we, that's the wrong button, just before we look at the news, yesterday on the indices, not a lot of movement. Markets yesterday correcting everything that happened on Friday, basically. So very nice breaks yesterday. Nice and clean on both, easy money yesterday. But no real movement. So market opened there and it closed there, opened there, closed there. So no movement at all yesterday on the indices. Very, very quiet day from a directional bias. Good movement intraday though. And same with the US indices as well. We had a fairly rotational day on the indices. So no movement really anywhere yesterday, which is not surprising after the absolute chaos that we had last week. See where these go this morning. I'll come back to those in a sec. So just kicking off with the news. Morning, George, Steve, AC. Today's no news day. There's nothing much coming out today. We've had Ivy PMIs this afternoon, and they got the auctions later at 6, but nothing else scheduled news-wise today. So see what happens. Nothing really to drive the market specifically. Overnight, we had the unemployment rate for the New Zealand dollar. That has gone up. We were at 4.4. It's gone up to a 4.6. 4.7 was the forecast, but 4.6, this is where it's a little bit deceiving. That's a green number indicating that's good. It's not good. It's gone up by 0.2%. So it's just slightly better than expected, but it's still bad. So New Zealand dollar, as you can see, screamed to the upside on the bad news. So yeah, big, strong push to the upside. Obviously, bad news means the currency goes up. Market's just off its head at the moment. Really is. It's just bizarre. That's a 0.1 miss on a forecast. So although it's not as bad as they thought, it's still not good. Which will put pressure on the New Zealanders to drop that interest rate down. We're up at 5.5. Inflation is still way too high. Unemployment has gone up. So they will want to get that down as fast as possible. But until we get this anywhere below the 3% level, they cannot do that. So it's tricky, New Zealand dollar, Aussie dollar at the moment, because they're really stuck. They're really lagging everybody else. But so we got ADR hits on the New Zealand dollar pairs. We'll look at all the ADRs and everything in a minute. But that's your news, basically, forecast for overnight and today. Nothing. The other overnight news, not a lot of info out. We had lots of Bank of Japan talk. They're getting really bullish now. Now it's all going their way. They're like, we think everything's going to be fine. Soft landing, all good, nothing wrong. Nearly went bankrupt. But anyway, no rate hike during market instability. Market instability. It's been an unstable market for you guys for about a year. Nothing ever makes sense what comes out of the Bank of Japan. But anyway, obviously, as you can see, the market didn't really have much of a reaction to that because interest rates are so unbelievably tiny in Japan. They're not, if you're not going to change your rate, it's not really going to make any difference, is it? Nothing else overnight really to report home on. That's the rates, unemployment rates. So that's it. So that's your news. So nothing forecast today. So it's just a case of whatever banks and institutions want to dump into the market today, we'll move it in whatever direction it wants to go in. Let's just quickly catch up on the indices. Bit of a lackluster open today. So DAX pre-market range hasn't, I mean, it's ever so slightly ticked out the pre-market range. It's about to hedge me into a long as well. So no directional bias at the moment at the open. No volume today. FTSE's just about sort of fallen out of bed, not really gone anywhere. So we'll see where these go today. So DAX hedges today. Tricky today, isn't it? I think I'm going to go just below last week's low, upside. So basically, last week's low, we tapped into that at the open on Monday. Wednesday, isn't it? Yeah, on Monday, and collapsed down, obviously. We came and kind of tested that area yesterday and couldn't get through. We've tested it again today and couldn't get through. So if we do break through today's high of day and yesterday's high, we're going to find limit orders triggering at those lows. So I'm going to target that to the upside for a long. Downside, yesterday's low, which is just shy of ADR. So we'll see where that goes today. But at the moment, it's not going anywhere. Probably the best case scenario today, that hedge gets paid for by a clean break on the FTSE. Not really doing anything, is it, at the moment? Right. That's your news. Morning. Can't say your name. Morning, Callum. So we will go through the FX pairs today. There's quite a few ADRs to look at today. So RSI wise, I'm just going to adjust quickly my dashboard. I don't know. No, I'm going to leave it as it for the minute. Because basically at the moment, I've reset the EA up to trade 80-20 4-hour. So I'm now live back again on 80-20 4-hour. I set it up yesterday. I got 2 trades on actually from yesterday. Euro pound. And pound CAD. So euro pound got short on yesterday from the 4-hour RSI. Up here, this is the one I looked at in the live room yesterday, and I was like, this looks fantastic as a short. It's got loads of things going for it. Levels, divergence, RSI extension, exhaustion, everything. It just looks brilliant for a short. So nice big target on that as well. It's going to go 150 ADR. Yeah, and pound CAD was also extended to the downside, so I got a long on that. But yeah, so I'm live now for H4 RSI extensions 80-20. I'm using RSI 10, but you can use, use whatever you want. There's no right or wrong. RSI 10, RSI 14, they're just different numbers basically. At the end of the day, no one knows which one's going to work, which one's not going to work, which one's the best to use each trade. So I've decided on RSI 10 because it gives you a few extra entries, but it's more the levels, the extensions have got to be really strong for me to get in at the moment, because I want to be a bit safer with risk while we're figuring out how quick these interest rate drops are going to happen. So there's a few extensions at the moment. We've got the pound CAD, which is extended on the 4-hour, which is what we're on at the moment. So this big drop down, obviously this week so far, it's been nothing but selling. It's tapped straight into that high. And obviously we've got potential for a pullback up into this area and then continuation short. So this is bearish. Both are bearish. Pound is bearish, and CAD, look, I can't get words out today. CAD is also bearish. Pound New Zealand also extended to the downside. Nice divergence, bullish divergence there. There's no reason really this should be a long. Pound is dropping interest rates. New Zealand dollar is not dropping interest rates. Their unemployment has just gone up, which is obviously bearish for them, but they're not going to be dropping interest rates. So it will probably pull back at some point, but I get the feeling we may well come all the way back down here and test. So big drop, big drop. Very difficult at the moment because all indicators are skewed by this crazy day that we had on Monday, 300 ADRs all over the place. So everything, ADRs, RSIs, moving average, every indicator you've got is going to be out of whack at the moment for this week. So indicators not as reliable as they would normally be. Not that they're that reliable anyway, but so yeah, so that's extended to the downside. So good long opportunity. That's also an ADR hit. So drop down M5, M15, reversal that's just about to go in on M15. You've just had a reversal on M5, which was tiny. Hardly even see it. So you've had a reversal alert on M5. We had that low put in, which gave you the reversal there. And that's obviously at ADR today. So good opportunity for a long on that one. Pound is probably going to want a little bit of a pullback, but I get the feeling we're going to see more flags than actual deep pullbacks on this pound because they've just dropped rates and we are now starting to see weakness coming into the pound. Euro pound also extended. That's the one I'm in short on at the moment. Target for me, I'm just targeting this high of last week. So I'm targeting this area here. Good chance that both of these propulsions will get hit. With the euro pound, it's very difficult to call. Obviously, euro's dropping rates and looking to accelerate the drop. Pound is dropping rates. We don't really know how fast it's going to come down, but they're both bearish. Absolutely no reason for that euro rally whatsoever, which is why I said it's such a good short opportunity. There's a good chance this is just going to do an A-shaped recovery. So if you can hold it for a week or so, potentially, you will be down there. So those are your extensions on the 4 hours. The hourlies, we've got Euro New Zealand extended as well. Again, bearish bias on that one. So not the greatest long in the world, and that's an ADR hit. Pound New Zealand as well. Also extended to the downside, also an ADR hit today. So again, good looking long. Pound odd and pound New Zealand, very similar pairs. So probably best not to get into both. Morning, Chucks. So those are your RSI extensions. ADRs, there's quite a lot. Let me just quickly look at what the indices are up to. Wow. Ooh, that. Absolutely no movement today. Dead. Market's dead. Hopefully we just get a little bear run. I think that's the best I can hope for today is just to have this pay the hedge. Really not got any volume, is it? We'll come back to that in a bit. So with the, as I've been saying all week, with the ADRs and the weekly range hits and monthly range hits, this week you've just got to scrap all of this. It's absolutely no use to you whatsoever because we had 300% of ADR and weekly ranges hit 250% of ADR in 2 hours on Monday. The whole market collapsed. So none of this, it's all played out. Any of these trades, if you had have got into them on Monday, you made money on them. They all did A-shape and V-shape recoveries. So that's all dead. Monthlies are really skewed now. You can't really use the monthlies this month because they've all hit. Anything that hits monthlies from now on, potentially you could look at for entries, but they're all over the place. As you can see, as I said on Monday, the ADRs are going to be skewed this week because we've just entered into a volatility spike this week. So ADRs are going to be hit a lot this week because volume is increasing. It's completely the opposite to what we normally get in August. August usually is summer trading. Summer trading usually get contraction in volume. What we've had is complete expansion in volume this time round, which is, again, not normal. But nothing's normal in this market. It does what it wants. But yeah, ADRs obviously are increasing. We are seeing a lot of expansion The pound yen ADR is 373. Look at these yen ADRs. These yen ADRs were sub 100 2 weeks ago. We're now up in the 400s. Yeah, 4 times the range that we were trading a week and a half ago, 2 weeks ago. Yeah, massive differences. So this is the Achilles heel in ADR, if there is one. The fact that obviously it's a lagging indicator and lags 10 days. So you're looking at the average range of the last 10 days. If you get 300% followed by 300% followed by 150%, these 2 days alone are 2 to 3 times what you've been having for the previous 8 days. So the indicator takes time to catch up and give you readings which are more accurate on what the volatility is. So with when you get expansions like this, ADR 100% and 125%, to a certain extent 150 is kind of becoming the new norm, and that will average out. So you want to take higher entries. So if you see things getting to the 150 level, that's really when you want to start getting interested, because obviously hitting ADR is very easy when you've got twice as much volume going through the market. So just take some of these with a pinch of salt. Obviously, bear in mind a lot of this ADR stuff today is caused by the news. So this is a good example. New Zealand CAD, we're 175 ADR, weekly resistance. So that is a good short. Yeah, you've had a reverse alert on it already on M5, I would imagine. Yeah. So there's your reversal alert there at 175 ADR. There's your retest. Target back down here if you want to go for that, but obviously just shorter targets on ADR reversals. But yeah, that's a good looking opportunity on that one. So New Zealand CAD, New Zealand Swiss, and New Zealand yen are the most extended things today. 150 ADR there. Again, you've probably had a reversal alert on 5. Yeah, so 5-minute reversal alert is in. That's your reversal alert there. And retest. There's your M pattern short. And New Zealand dollar yen. Again, beautiful M pattern reversals going in at AZRs today. So really good entry short there as well. So there's lots of ADR hits today. A lot of the Aussies and New Zealand's will hit because obviously the news, but also the Swiss and the yen are on the move again today. So fair bit of movement on these Swiss and yen pairs, but the market's just completely woken up this week. So that's why I kind of said you want to give it a few days to figure out what it wants to do after this catastrophic move on Monday. So all indicators, all readings are going to be all over the place at the moment. Aussie 8% risk is based on balance, not equity. Yeah, that's correct. Right, so I'm going to go through all the pairs today. Just going to have a look through everything, see where everything is, have a look for opportunities. Although at the moment it's quite tricky, as I said, because what happened on Monday, we've had the A-shaped and V-shaped recoveries. Those were the best opportunities this week. Everything now is kind of back to where we were. So again, absolute nonsense, all of the movement on Monday, as I said. And now we just need to figure out where we're going from here. So looking at the biases, just to let you know as well, I'm working on a new bias scorecard. This bias scorecard that I've put together is great, but when it loads, hello. No rush. There we go. This bias scorecard, obviously, when I put this together about 18 months ago, it was good to use as a directional bias, as a top-down view. But obviously, as soon as I did that, everything stopped moving with interest rates. So I'm working on at the moment a new bias scorecard, which is much more detailed, which is going to take into account all of the major red news events. So it's going to take into account obviously interest rates, obviously definitely, But looking at everything that's red, PMIs, all the red news, basically, everything we see, the unemployment rate, unemployment change. And so I'm going to build a more detailed bias scorecard, which is going to look at the differentials on each of the news events and scorecard those as well. But not just those. It's going to scorecard the forecasts. And also one thing that's missing at the moment is kind of analysis on bullish and bearish rate statements. So we've had the Aussie come out on Monday and say in their monetary policy statement, they are not going to be changing interest rates this year. No near-term interest rate changes are scheduled, and there's a possibility that we will have a rate increase if CPI pops. So you kind of need something in your scorecarding system to say the Aussies are massively bullish, whereas data won't tell you that. If you look at the statement that not changing, that's neutral. It's not neutral. The fact they haven't changed it is because they want to put it up. It's massively bullish. So the data's kind of skewed. So when you see things like this on the scorecard with the interest rates for the Australians, they're all range bound. They're not. They should all be buys. Yeah. Or rather sells, rather. The pound odd should be a sell. The euro odd should be a sell. The odd CAD should be a buy. The odd yen, no idea. Odd New Zealand, odd Swiss, odd US should be a buy. Yeah. So this scorecard, while it's a good top-down overview, it was really good when we had normal sort of conditions going on. We haven't at the moment. It's not like that. So I need something that's a little bit more month by month, week by week, day by day, with every single news event. So I'm in the process of building that out at the moment. I need to figure out the logic in it, basically, but I wanted to build something a little bit more complex. So I'll update you on that when I get a bit further down the line on it. But so we'll go through all the pairs today, have a look at everything. Morning, Abdi. See where everything's going, look for opportunities. So obviously with RSIs, you can pick whatever RSI you want to. It's just an extension. It's just showing you where price has been, where it's moved to, and what we're expecting to come next. So, but also levels. There's some really good levels we've seen this week being hit by these moves, which potentially have got opportunities to get in. So we'll have a look at all of those. So starting with the top, Aussie CAD. Obviously, this has had a big drop down. The news this morning for the New Zealand was obviously not great, but at the moment, the bias for the Aussies is long. So they're looking for CPI to drop dramatically. If it doesn't, they may well put interest rates up again, which means it will be bullish. The Canadians have dropped interest rates and are going to continue to drop interest rates. The US have now said they are going to drop interest rates very fast, which will pull the CAD down with it. So the bias on the CAD is definitely bearish. The bias on the Australian is, even if you were neutral, this is a bull. So down here is a good spot to be buying at the moment. We've had an RSI extension. So at the minute, obviously, we're in the middle of a pullback. Got low, high, higher low, higher high. There's your higher low. So market structure bullish, fundamentals bullish. Great area to be buying it. We tapped straight into that propulsion gap and bounced straight out of it. So looks really good for buys at the moment. So you've had reversal alerts on pretty much every time frame now. But obviously, as I said, every indicator is going to be a little bit weird at the moment because of this movement. So the entry on this one was really on that candle there, but you didn't get a signal until today on the hourly time frame. So longer term, you're looking at probably retesting those highs and breaking them from last month. So how it gets there and how long it takes to get there, we don't know. But it's definitely a good looking long. Aussie Swiss, all the Swiss pairs at the moment, the Swiss franc is, this is why I took the Swiss franc out of my portfolio. This is what I was worried about, which is why I removed it, because Jordan now has said they are going to manipulate the Swiss franc bullishly or bearishly as they see fit and however they fancy, whenever they fancy. So it's become a little bit like the yen in the fact that they can just intervene whenever they want to, which means that it doesn't matter any technical analysis, any fundamental analysis you're using. If the Swiss decide, actually, I fancy dumping a load of it today, it's just going to collapse because the market has no way of forecasting, predicting. It's using risk in the same way as everybody else is. So if they get caught offside on it, they are also going to go into the hole, which means that the movement becomes way more erratic than normal. So you can see from this massive sell-off we've had, this is what, 1, 2, 3, 4 weeks, a month. We've done 715, so nearly 10 ADR in a month. Absolutely monster move. So just be a little careful with anything Swiss. It's still not on my radar at the moment. Look at the divergence on this thing. I mean, you can't even draw the divergence on it. It's that big of a move. Timing dash. Aussie New Zealand's just hit ADR. I mean, it's absolutely vast. It looks like a beautiful long, but the Aussie is bullish. But, again, with what's going on in the world at the moment, one missile into Israel from some other country that actually gets through the Iron Curtain and whatever it's called, the defense system, this thing's coming down like a rocket. So you just be very, very careful with the Swiss at the moment. RSI on this thing at the minute, not reliable. It's not moving normally. Don't forget, any instrument that you are trading, any indicator that you're trading will be useful in normal market conditions. Abnormal market conditions like we've been seeing over the last few weeks, nothing's going to work. Doesn't matter what you're doing. Doesn't matter if you're a trend trader, a mean reversion trader, or a breakout trader. None of your signals, systems, and indicators are going to do what they normally do. So it's just a case of sit back, wait. When this returns to normal, which I suspect will be when the US dollar interest rate drops that first time, because the Swiss at the moment are doing what they need to do because we've got everything else going wrong everywhere else. When we see that interest rate dropping on the US and everybody starts to know what the bias on the US is going to be for the foreseeable future, I think the Swiss will probably come back to a bit more normality. But right now, big money making opportunities on this thing. As you can see, it's doing massive ADR moves, but you've just got to be in it at the right time. So it's kind of a flip a coin thing. So all the Swiss franc pairs at the moment are hugely extended and all look like great longs. Yeah, just look for support resistance areas to the upside to trade back into. You've got a monthly low there to trade back into. You've got massive propulsion gap targets to trade back into. But one thing goes wrong in the world and this is coming back down again. So just bear in mind, anything that you're trading on the Swiss at the moment, it's the currency, the Swiss and the yen. For position trading, not great. For any stop loss based strategy, go for it. Not a problem at all. Obviously, you're limiting your downside risk. And you've got the opportunity to make an awful lot of money. Yeah. But you look at the speed this thing's been coming down. It's the same old thing, isn't it? Bang. Bang. Yeah, it's just the movement is erratic and it's forced. So not normal structure. So all these Swiss franc pairs at the moment, the bias on the Swiss is bearish. Yeah, that ain't bearish, is it? For 4 weeks, this thing's been like a steam train and it's come out of that. So they're dropping interest rates unexpectedly, faster than expected, without telling anybody, which makes it massively bearish. Yet it's been the most bullish currency we've had for the last couple of months because they're manipulating it. So, you cannot use fundamentals on it. You can't use technicals on it. It's just a case of get in and hope. So that type of instrument for me at the moment, not really interested. So all of these, you have to say from a technical basis and from a fundamental basis, they're all great longs. Yeah. Massive divergence again there. But, difficult to call. This one specifically is much more bearish as well. So if that Swiss does power up, that's the one you want to be on short. That's going to absolutely collapse in the same way as the US dollar yen did. So, which brings me on to the yens. We'll quickly look at the yens, look at all the Swiss and all the yen in one go. We've just hit this beautiful support on the US dollar yen. So this area here is where we bought up that rally, which was the new market structure long. At the moment, the yen is on an absolute, free fall, basically. Everybody is buying the crap out of the yen, which is partly to do with what happened in the stock market. This is the carry trade used by banks, institutions, pensions, hedge funds. Yeah, if you want to make money, you buy the US dollar yen because the swaps are so ridiculously large and the interest rate differential is so massive. You can't help but make money if you buy it. Yeah, they're all offside, underwater from the intervention move. So again, this one, there's a lot of market participants and analysts at the moment calling this the bottom for a new leg up. There's a lot of people saying that this is the start of the decline of the US dollar and the Japanese yen you want to be selling on every pullback. I don't know. I'm not trading it. But all the time it's doing stuff like this, again, it's got to be a stop loss based strategy that you use with it. It's no good for position trading at all. So I'm steering clear of all the yen pairs. I will introduce it at some point, but we need some normality. And the fact that the Japanese have just come out and said that they're probably not going to change their interest rates this time round, after saying that they are going to do it every month regardless, don't worry about it, guys. Again, changing their minds, has thrown a little bit more confusion into the market. As you can see, the yens today, we've had a lot of ADR hits on all the yen pairs today because they've changed their mind yet again. Yeah, every yen pair ADR. So all the yens, again, look like really good long opportunities, pulling back somewhere on that leg. So, always look for logical places on all these moves. So a shallow pullback is typically 38, medium pullback 50, deep pullback 61, 71. Yeah, flag 23. Yeah, so we've broken above a flag break sort of level there. So it could pull back easily to any of these propulsion gaps. They're all decent levels where you would expect additional sales to come in if that is what the market wants to do. So if you need to make up your own bias on it. No one knows which way this is going. So if you think, yeah, I reckon the US dollar is going to be weak over the next rest of this year, and I reckon the yen is going to be strong, you want to be looking to get RSI extensions to the upside for shorts, ADR extensions to the upside for shorts. You want to be buying or selling these propulsion gaps short. If you're opposite way inclined, you're probably long on it. But I have no clue, and there's plenty of other instruments out there that are more logical. So steering clear. So all the yens in exactly the same boat. Again, exposure. Trade one yen pair. If you're going to trade the yen, trade one. Don't trade anymore. There's no point. They're all doing exactly the same thing in exactly the same way. If you get into two yens, you're overexposing yourself on something which is wild and could do absolutely anything. Same with the Swiss. If you want to trade the Swiss, look at them all. They're the same thing. They're all the same pair at the moment. There's too much confluence between all the pairs. Just trade one of them. Yeah, but direction-wise, very, very difficult to tell. Everything's going against fundamentals. So all of those, confusion reigns. So just finishing off the Aussies, Aussie New Zealand, bullish at the moment. So with the Aussie and the New Zealand, tends to be very, very rangy the vast majority of the time because they're close trade partners. But when we do get fundamental differences, it usually is the Aussie that wins out because it is the bigger economy, the stronger economy. So at the moment, obviously, market structure is long. So it looks like a good long. The New Zealand has just had negative news this morning. Although it's positive and negative because it wasn't as bad as they're anticipating, but it has still gone up. So it is still bad. So at the moment, we've had the reversal alert on the 4-hour, and this looks like potentially the retest area. I would suspect we'll at least come up and retest this area and get this propulsion gap done. But it may want to come a little bit further down, deeper, before it does it. So we'll see what happens with this one. But Aussie New Zealand, again, not one that really I'm trading at the moment because it can go a little bit wild. There's plenty of other pairs with Aussie and New Zealand crosses to trade. This is the more volatile and dangerous one, because when it goes into a mood, differential, it does things like that. So it can be a big trender, this one, but the vast majority of the time you'll be just range bound on it. And at the moment, it looks to me like it wants to kind of go into a nice normal trend. But if it goes into a parabolic one, the reason it will do this or this is if one of these decides to change interest rates without telling us. You won't get out. You'd have to take a loss on it. So there's better things to trade out there at the moment. But for me, obviously, with RSI extensions, you can see this one here got extended down here. You would have been out on it after about 3, maybe 4 trades. It is still working at the moment, but it just worries me slightly that it might go into a parabolic move. So because these guys are both lagging interest rate and inflation at the moment, they will want to get that interest rate down as fast as possible. As soon as they see a decent CPI move, there's a chance that we might get a shock interest rate drop on one of them, and that is going to cause it to either shoot that way or shoot that way and not stop for a while. So if you wanted to be super safe, and this is obviously a much more complex way of trading, but you just watch when the interest rates are coming out on these, and you make sure you're flat a couple of weeks before interest rate announcements. Until then, there we go. Got New Zealand coming up next Wednesday. Look. So the market may well position itself into a long or a short ahead of that, but highly unlikely that's going to change. But if they did drop it by 0.25%, Aussie New Zealand is going to take off in that direction, and it's not going to stop. So you're going to get one of the moves looks, like these big parabolic moves that you see. It will just go and it won't stop for a while. So just be a bit careful with the Aussie New Zealand. But there's no extensions on it at the moment on the 4-hour or the hourly. It was extended on Monday, and obviously that's played out, but that was a isolated incident. Aussie US, so bias on this one is a long. US dollar interest rates coming down, Aussie interest rates potentially going up but not moving. It's a long. So where we were on this pullback was looking good for entering long positions, and obviously they screwed everything on Monday. It looks good to me. This reversal that we got on Monday is a good confirmation. We've made a new high today. So if we can break out of last week's high, I think we've got a good chance of running up and testing the high of the month. So looks good for longs. You had your RSI extension back here to the downside on the 4-hour. The 80 level got broken somewhere in there, and it just collapsed down because that US dollar move. So looks good for longs. Long, if you scroll out, we're down more at the lows, and target would be up at those highs somewhere. But assuming the Fed does what the Fed says it's going to do, we should see continued weakness coming to the US dollar. It's not going to go like that, but it should be much more bullish than bearish. So more longs than shorts. Looked at the Swissies and the Yens. Euros. So anybody that's in any Euro shorts, you may well be out of them now. Obviously, after this push up that we had on Friday, that parabolic move, as long as you were entering positions at decent spacings, you should have some entries on up there, which will hopefully help you get towards an exit on this. But absolutely no reason why that shouldn't do that. Lagarde's increased the pressure on interest rates. They will be dropping potentially faster and harder. So the euro should be bearish. Aussie, as we know, bullish. So, yeah, this thing should be coming down fairly nicely. We took out, this is one of the ones I looked at yesterday on Monday. Beautiful higher year retracement from last July. So, yeah, we knew there would be limit orders at yearly highs and lows. There always is limit orders at yearly highs and lows. And that one certainly got run over. So I suspect we'll see some kind of weird head and shoulders formation on this. And we'll be looking for short opportunities. So if you do pull back into propulsion, if it does manage to get back up into there, I'd look to add more shorts in. Hourly is probably better to look at because you've got a reversal alert. So there's your reversal. That would be really the extreme to the upside, but there's a good chance it will just keep flagging and dropping from here. So we'll see what happens, but certainly should be shorts. RSI extension to the upside there from Friday. But there's been so many extensions to the upside and we got embedded. Look on the hourly. This is one of the reasons I've switched back to H4 from hourly. Yeah, when you see this type of condition starting where it just grinds, yeah, RSI becomes useless because there is continued relative strength. Therefore, you get continued signals. Yeah, what we're looking for is good structure, market structure movement, which is what we haven't been getting. When you switch up to the 4 hour, you get a lot less signals. And again, looking at the 80 levels, you still would have been in there on this particular one. There's nothing you can do about this move. This move's just ridiculous, isn't it? This whole stuff is just not normal. What you would normally experience is a pullback off of that level, which obviously everything went wrong last week. You can see the volatility spike, look. Yeah, look at the normal weekly movement. Yeah, and then look at that massive spike. And this is where it all started to go wrong. And then you've got this massive volume expansion, which is what we should continue to see now, bigger volumes coming through. So good looking shorts. So if you are in it still, possibility of a pullback into these areas. But if you want to get aggressive drawdown control positions on, anywhere in there is probably a decent area to try and get some on. Euro CAD, same thing. Lovely pullback at the moment. We've just tapped into the high of last month. Limit orders triggered. Can't quite see that. I should zoom in a bit. So high last month, limit orders triggered. Yeah, they've been run over. So any buyers that were trying to continue that long have probably flipped short, which will help the market drop today. So we've got no news. So hopefully we'll get that drop continue today. And then we'll be looking to break that low and continue to the downside. CAD is obviously a short as well as Euro. So this might be a bit slower on the way down, but it all depends what happens with that US dollar. Don't forget, when the US dollar drops, the CAD tends to drop with it. So if the US dollar, there's talk of them doing a emergency interest rate drop potentially next week. Whether that happens or not, we'll have to wait and see. If it does happen, you're going to see a massive weakness in the US. Obviously, that's going to do that. So any of these that you're in, any bias longs on the Canadian or the US, if you can get a break even or take a small loss on them just to get flat, probably the best thing to do at the moment. Come to Swiss. Euro pound, first short taken on that one yesterday. So again, that's come up to a lovely propulsion sell area yesterday. It's trying to go long again a little bit today, but this looks like this is just, you can't find this on a chart. This move that we've had is just nuts, isn't it? So yeah, I'm looking for an A-shaped recovery on this, or at least a pullback into one of these levels. So as you can see, my target is there, just above that monthly high. Worst case scenario, that if you look at this on a daily, see the size of the propulsion gap. followed by the size of the propulsion gap. I mean, this is just one massive propulsion move starting from there all the way up to there. So we just put an inside bar in yesterday, which is pause candle. So as long as we don't break yesterday's high today, the market is exhausted. Yeah, we've got highs coming up where they're going to sell from. So we should see a pullback start from here. Whether or not the bulls or the bears win with the pound and the euro, because obviously both of these are now dropping interest rates, it's difficult to tell. But we shouldn't see this. I mean, this type of movement that we've had on the euro is just ridiculous. There's absolutely no reason for it whatsoever. Market's just gone nuts, obviously, over the last week or so, isn't it? So especially obviously this week. So we're looking for shorts. No reason why we shouldn't continue this downward movement. Both dropping interest rates. Pound will be the stronger of the two. Therefore, it should be bearish, unless obviously something changes in the meantime. So looking for shorts on that one. Daily RSI extension. Look at the 80 level. Yeah, super, super, super rare. It takes something absolutely nuts to get us above the 80 level on RSI on the daily time frame. COVID, Liz Truss, doesn't happen. No reason for this. Yeah, this is just panic. This is market selling off, going, holy crap, we've gone into extreme fear mode really, really quickly. What's the US doing? Why are they sending missiles in there? It's all going wrong. Oh, hang on, no, it's not. That's basically just a panic move. So this should undo itself 100%. So huge extension there, which we don't normally get anywhere near these levels. As I said, I did the analysis, which I went through on Monday. Last week, I went through all the RSIs, looking for confluence and previous instances of these types of moves. It's just nothing you can prepare for. Doesn't happen. So these are almost like the black swan events. Yeah, but this is obviously not a black swan. It's just a ridiculous move, which is unwarranted, obviously, but not something we've seen before. So when you get extensions above this level, you kind of have to just go, chances of that happening again in the future, unbelievably rare. Saying that, markets change. Yeah, this might become the norm, doing silly moves like this, but unlikely. Don't forget, banks and institutions can't sustain these moves either. Yeah, they're caught offside on these. They will be screaming at their market maker desks to take every possible short available. Yeah, they will want the market made short because they need to get themselves out of these positions as well. Don't forget, they do a very similar thing to position trading. They are DCAing into market movement. However, they can create the market movement, which is why they don't lose. But, they will be massively offside on this, wanting to take profit. So, brilliant selling spot. Euro New Zealand, A-shaped recovery, already gone in on this one. So Euro short, New Zealand long, confirmation obviously of interest rate potential rises from the Aussies, which will drag the New Zealand dollar with it, and unemployment going up on the New Zealand dollar makes that not really bearish or bullish, but it means that it's not going particularly well. So yeah, definitely shorts on this one. So at the moment, the RSI extension to the upside was an entry from from Monday. There's been plenty of signals on this over the last couple of weeks for shorts. You would have been out of any shorts that you'd taken that week or that week last week. And obviously a new entry this week, which is already done. So if you flipped long on it, obviously from that extension, you're out. So yeah, big money maker, this one. Easy to trade at the moment. So at the moment, no signals. Hourly, you've got an RSI extension to the downside. So good looking push up into propulsion, into the reversal. Yeah, so look for a continuation short. You've got nice support coming up as well. So if you do take a long here on whatever time frame, M15, just had a reversal on M15 at 125 ADR. So if you do take that and it doesn't work out, you've got a second entry at 175 ADR where they buy up last week's low. Euro US dollar also bearish. Well, this is a tricky one now because obviously we're bearish on the euro. Now we've got the interest rate drop promised from the US. Promised, not done. This is a bear against a bear. It's difficult to say how quick this one's going to move because obviously we are in a range which we've been in now for quite some time, going back to, where are we? November? Sort of October, November time. So this is going to start to break out, but it's going to be dependent on who drops the fastest. And it's difficult to call at the moment on these two. So if we look at the fundamentals on them, the euro basically, we've got drops already starting, as we know, and we've got forecast drops now on the US. So the euro is at 4.25, no change last time. We are forecasting a change in the next interest rate announcement. 2.6 with an ever so slight bounce on the inflation. So this coming down basically will continue this to drop. They're expecting this to drop faster. They were expecting a bigger bounce. They didn't get it. So they're expecting a faster drop, which means they need to do that. So euro getting more and more and more bearish faster. US dollar still at 5.5, and we still are up at that 3%. We haven't even cracked that yet. Target is 2. We're nowhere near it. So it's difficult to tell. If they drop that by 1.25% this year, which means they've got to do 0.5% drops, really. The US dollar could come down very, very quick. So it's going to be a case of, I think, with the euro US dollar, we're going to see the same sort of price action that we've seen, where we're getting a few weeks up, a few weeks down, a few weeks up, a few weeks down. And that's going to fall in line with CPI numbers and interest rates, CPI numbers and interest rates. But if euro go, actually, no, we're not going to drop interest rates, and they go, yes, we're definitely doing a half, you're going to see that pop. So it's very difficult to call at the moment, but because these are two, pretty much the largest currencies traded, it's the most liquid pair on the planet. There's more liquidity goes through the euro US dollar than any other FX pair every day. You are going to see constant movement on it. So I don't see any reason why this should go into any kind of parabolic trend. So we should be able to just trade it as normal, all extensions. So at the moment, as I say, with the H4, I'm looking at the 80s. I don't see any reason why you shouldn't just continue to do exactly the same thing. Yeah. Even if it goes into a kind of a big, strong trend, you've got these big moves and these big pullbacks, these big moves and these big pullbacks. They're all big enough to get you out of most of the time. Yeah. So I'm just going to continue to long and short it as long as the fundamentals they are both bearish. If Lagarde suddenly comes out and goes, whoops, inflation's popped, we're probably not going to drop interest rates for this year, it's going to go up. So we just got to keep our finger on the pulse, which is kind of why I'm looking to put together this new scorecard, which is going to be more granular on each news event, because every news event is important. Obviously at the moment, the scorecard just takes into account the key four, which is interest rates, inflation, unemployment, and GDP. So we're going to start looking at the PMIs and all the other stuff in more detail. So euro US dollar at the moment, beautiful high retracement. And we've got this wacky great propulsion gap on the 4 hour. So good looking short opportunity, but it could well get bought back out of there. So at the moment we are market structure long. This will be where your lower high will go in. But we don't know what's happening with the interest rates and things. But longer term, we are in contraction. So the market undecided at the moment. We are moving into contraction, which means typically you will get an explosion, symmetrical triangle. So at the moment, just waiting for extensions, but it's a short at the minute. Pound obviously is weak at the minute. Basically, interest rates have dropped for the first time. We've been waiting for Bailey to drop the rates for months and months and months. every time they say we're going to do something, they've changed their mind, but they've finally dropped the rate. So this CPI number that we have next, we froze CPI. They were expecting a bounce. They are still expecting a bounce. So inflation is expected to go up. If that CPI number does not go up on the next announcement, they will be dropping. And I think there's a chance that they'll start moving into 0.5% because they'll be very worried about this dropping too fast. So we've also got this civil unrest going on in the UK at the moment. There's more riots forecast for this evening. That doesn't help your currency. When there's instability in the country, there's instability in the currency and weakness. So the pound, you've got to be looking at shorts on everything at the moment. At the moment, the unemployment rate is stable. If that starts to come down, then it may get a little bit more bullish. But again, everything we're looking at is based on what should happen, which is weakness. Pound odd specifically, the Aussies are not dropping their interest rates. We definitely are. So it's got to be a bearish bias on this. Got a couple of weeks worth of run up in it, and that now is starting to drop. So again, another one which hit the yearly highs. So looking for basically that sort of movement. So shorts much better than longs. There's an argument at the moment. Somebody contacted me in Telegram, and I kind of agree with what they were saying. It's not something you can really do with them. You could do it with the position trader EA and the market reverse alerts EA. Yes, you could. I told them the wrong thing. Someone contacted me and said, if you've got a bias on something, for example, on this one, pound odd is a short, fundamentally. Why not take weaker signals on your shorts and stronger signals on your longs? So, for example, if it gets above 70, go short, because it's unlikely, if it's going to drop, to get above the 80 level. Yeah, we're not going to get a strong push in a bear market. You're much more going to get a strong bear move and a weak push. So it makes sense to use the 70 level, or in fact even less if you wanted to, but that's pretty aggressive. But use the 70 level for shorts and use the 20 level for longs. So if it comes down really, really, really hard, we'll take that little pullback. But we don't need it to go up too far before we're interested in shorts. Same with ADR reversals. If there is an ADR hit to the upside to 100%, take it. But I want it to go 150 to the downside before I long it, because it's a bearish bias. So I just suddenly realized that is actually possible to do with the position trader EA and the market reverse alerts EA, because obviously you can set independent high and low triggers for RSI. So yeah, I'll have to reply to him. But yeah, that is something obviously that is a potential now if you wanted to do that, because obviously we're looking, when you're looking at you've got a directional bias for any reason, you are expecting the market not to push as hard and to push further down. That's what market structure is. The drops are stronger than the pops if you're in a downtrend. That's why market structure is what market structure is. So it makes sense that it's not going to push up as far. So if you were a fib trader, for example, you would be looking for sort of 38 to 50% retracements in a downtrend. If you're in an uptrend, you'd probably want it to go a lot higher before you got into one. Yeah, because you're expecting it to make a new high, aren't you, before it pulls back. So that is something you could look at potentially. So I just went off on a tangent then, because I just suddenly realized you can do, and I told the person you couldn't. Certainly, because all my testing, I always use symmetry with all testing that I do. Any indicator I test, anything I do, I always test symmetry, because the market goes up and down usually in equal proportion. Even in a trend, in your downtrends, you want to be doing the same thing in your uptrends. Yeah. So you always want to be using symmetry. A lot of people do say, the best setting for this is using 90 and 45. Like, that's completely random. You use 90 and 10. 45 and 55. Yeah. So that's why I always have symmetry in the market, because if it's going to range, it's going to range with similar power. If it's going to trend, you want the same type of strategy on an uptrend and a downtrend. So you want to use the same levels. But when you've got a fundamental bias or a bias, you can adjust this to say, I'm not worried if I get in a little bit too early on the shorts, but on the longs, it needs to be really stretched. So might play with that idea a bit. But anyway, it's difficult to test because you've got to run short-term tests in back testing. Yeah, and you've got to know what your bias would have been at the time. Yeah, if using a moving average, it's not a problem, is it? But moving averages is rubbish. So pound odd, definitely want to be more short than long, but equally, the pound I do not think is, unless that CPI number drops below 2 or doesn't pop, I think the pound is going to come down fairly slow with interest rates. So I'd be very surprised if we're below 4 by next year, to be honest. But we'll see. Pound CAD, already got along on this one. So again, great example of what I've just been talking about. I want it below the 20 level if I'm going to long it, because my bias is short. So I want it to be really stretched and moved a long way before I take that little pullback. And my targets on pullbacks are going to be shorter and smaller than they will be on my shorts, because I'm expecting it to drop. So pound is a bear, CAD is a bear. Same thing with the euro at the moment. Euro against the CAD and the euro against the US dollar. If the US dollar crashes really fast and hard, even though the bias on this is short, the bias on the other one is going to be stronger. So there's nothing wrong with the pound rallying like crazy, even though it's bearish, if the other currency is much weaker. Don't forget, the whole market moves on currency strength. You've got two weak currencies against each other. One of them is going to be weaker than the other one, which means the market goes up. So at the moment, long on, looking to get up into there. We've got a nice propulsion gap, potentially for a second entry. You can see my next long is going to be there in that propulsion gap. And we've got that nice accumulation there, which is kind of playing off of these highs here at 225 ADR. So if this does drop further from where we are now, we're already massively extended. So you're looking at getting somewhere potentially down into that area. You're going to get a pop. So it's going to pop. It's probably going to test the lows of the previous week. There. So that's my target. The upside. Pound Swiss, pound yen covered, pound New Zealand, nicely dropping. Again, bias on this one. Got to be a short. Yeah, pound is dropping. New Zealand is not dropping. So yeah, again, same thing. Big drop there, nice exit. We're coming back down again. So if we do get extended further on the RSI, I'll be getting in long on this one and I'll be looking to come out of this propulsion gap. And that'll be your A-shaped recovery. Look at that for a head and shoulders that actually worked. Yeah. Don't see them very often. And it's a tiny little shoulder, isn't it? Exclude that wick. Yeah. This is why head and shoulders is so discretionary. A lot of people are going, that's not head and shoulders, because look, the shoulders are not anywhere near the same, and you've got another little bit of a shoulder there. But at the end of the day, it's a push, a pull, a push, a pull, a push, a pull. Bears back into control, isn't it? Head. But yeah, so looking for this propulsion gap to get tested to the downside at some point. It may well do that and then do that, or it could do that and then do that. Don't know. But I want it to be a little bit further down before I get in. Hourly RSI extension, you're back down there already. So again, hourly, not as reliable at the moment. When you're going through volume expansions like this, you're going to get so many embedded RSIs. Doesn't matter what you use RSI, any oscillator you use, CCI, MACD, stochastic, they're all going to get embedded. Yeah, when you've got parabolic moves like this going on, volume expansion, no indicator on the planet that is oscillating is going to help you. So yeah, this is where higher time frame trading comes in. All this chop down here is all being filtered out higher time frames, which is why higher time frames is much more reliable than lower time frames. Lower time frames, you can get more opportunities, make more money. Lower time frames, you get more opportunities, you lose more money. Higher time frame, better. Pound US dollar, again, same as the euro US dollar on this one. Dependent on the speed of the drop, this will either be like that or like that. It depends. We do not know how bearish that US is going to go. The more every time they open their mouth and say the word recession, that's going to pop. Every time they open their mouth and say anything to do with more interest rate drops than they've said already, that thing's going to pop. If they just deliver what they've said, which is 1.25% in the next 4 months, which has got to be 0.25% and probably a couple of 0.5% in there, then I think this is probably going to do something more like that. Yeah. So it's very difficult to call the directional bias on this one because they're both going bear. So again, anything that is a bear against a bear, you should get decent market structure on it because you're going to get those cycles of their CPI numbers and their interest rates coming out spaced out nicely, which gives them a push and it gives them a pull and it gives them a push and it gives them a pull and a push and a pull. And that's exactly what we want as position traders. We want the market to be pushing, taking profit, pushing, taking profit, pushing, taking profit. As long as it's going to do that, and there's no reason why it shouldn't, you should be able to take it in either direction. But as I said, at the moment, I want the bigger signals, the stronger signals, because this market is getting way more volatile now. Big expansion starting to come. We're entering into the potentially the fastest interest rate drop we've had for decades. So we don't know what impact it's going to have. So more caution, less profit, but safe. New Zealand, covered these basically this morning. Obviously, we've had the 4.6 unemployment rate. So unemployment has gone up. They're not dropping their interest rates. So New Zealand dollar is bullish, Canadian dollar is bearish. So we should be seeing, and we are, bullish market structure forming. So that I would say is probably going to be your low. So you've had the reversal alert there, and that is what we should see. And again, the speed of the movement will be based on the Canadian, and the Canadian will be based on the US. So longs. Obviously, you've got to take oil into account with these as well, both commodity pairs. So yeah, bullish movement. So looking for RSI extensions to the downside. Obviously that one worked. You know, this is the thing with RSI and why it's so good. It's just measuring strong bank movement, and after strong bank movement comes profit taking. So you can probably trade this in both directions. The New Zealand dollar is the weaker Australasian pair. It's just obviously you're better off waiting for the bigger, faster moves because they will correct faster. Don't forget this. There's two things at play in the market: distance and speed. So you can move a long distance over a long period of time. If you move a long distance over a short period of time, the pressure to undo a percentage of that happens faster. Yeah. So with speed and movement, you get speed in the retracement, which is what the RSI extension above the 80 and below the 20 level is signaling, is the condition is faster than normal. Yeah. We can hit that level, look, after 4 or 5 days of continuous drop. But to get below that 80, above that 80 and below that 20, it's got to do a similar sort of movement within 2 to 3 days. Much, much faster, which means you get a much quicker ping back. It's the elastic band theory taught in the bootcamp, yeah? Further that is stretched, the faster it's going to snap back. So that's why I'm moving over to the 80-20, the old ways, basically, for the moment while we've got this volatility coming in. But New Zealand CAD, you can trade in any direction at the moment. Both, it should be more long than short. but I think with the Canadian, you can go either way, really. US, we need to be a little bit more careful of. This is probably going to be a little bit more bullish, but again, no extensions at the moment. Looking for potentially that. So we'll have to wait and see if this low that we've just bounced out of holds. But at the moment, it looks like it is. So that's where we're headed. And then we'll probably bounce out and come and retest those highs. All depends how long they drop for and how quickly they drop for. Don't forget the other fly in the ointment is in November. We've got the elections coming up in the US. There will be pressure there for lots of movement in the markets. So there's so much going on at the moment in the world with everything. It's very difficult to know when things are going to move. So politics has a lot less impact on financial markets than it does on the stock market. So less worry about it, really. But we will be potentially looking for longs more than shorts on this. So again, something if you wanted to consider it, looking for 30 level for longs and 80 level for shorts. Even that one there, look, took a few weeks to play out. And the US dollar CAD is the last one. So the US dollar CAD has been completely sideways for a long time. We are now in a much more contracted range. Now we've got these interest rate drops forecast, and we know that we're dropping these interest rates. These two should behave in a very, very similar manner. The only time you're going to get big, strong, awkward to get out of movement is if there is a shock announcement from one of them as to a change in policy. So if the US delivers its interest rates as it said it's going to, and the Canadians haven't really said what they're going to do, but they are going to drop as well, we should just see normal market structure. And it's been a dream. There's very little I could have done wrong on the US dollar CAD over the last year not to make money out of it. It's just been a dream. I've made loads out of all this movement. It's just up, down, up, down, up, down all the time. All RSI extensions are just playing out. Doesn't matter which one you pick. You're going to get the odd move there where the US will change their mind. Potentially that could still happen. So even then, if you're taking the 80-20 extensions, you're not going to get into that until there. You got 1, 2, 3, 4, maybe 5 in a position before you get out. All my back testing on the 80-20, 4 positions really is the extreme. 5, getting into the 6s and 7s, which you can do, and 8s, and which you can do on the hourly RSI extensions, doesn't happen on the 4-hour because it's got to have moved so much further to get that extension. I don't think it will be unsafe to trade this. In fact, this one potentially you could stick on the hourly. You can see how easy it's been to make money on this thing. Up, extension, down, extension, up, extension, up, extension, down, up, down, up. It's just dreamy. Literally just continuously. If you've been using the position trader EA specifically on this one over the last sort of 6 months, it literally just goes long, it exits the long and immediately flips short, and then exits the short and then immediately flips long. And that's all it's been doing. It's just exiting and entering constantly over and over again. This one here, you'd have got in somewhere there, and we had a little bit of a squeeze on this one and an exit there. Yeah, so worst one lasted about a week and a half. Don't see any reason why it shouldn't continue to do that. So bias on it is bear and bear. Should continue to do the same thing for the foreseeable. So there we go. That is everything today. Let's just see where these indices are. Oh, lovely. I'm hedged on the FTSE as well. So double hedge today. I don't think I'm going to get out of these because this thing doesn't look like it's able to move today. I'm going to leave the targets where they are. I mean, it's going to it's just not moved, is it? So we'll see if we can test last week's low, which is high of the week. We should see some limits. Just looking for a reaction, basically, to get out. Even if it does that, as long as we get a reaction, we'll get an exit. And downside yesterday's low. FTSE, more tricky on the FTSE. I'm going to go with yesterday's low. Last week's low. We haven't tested that this week. Monday, obviously, we just collapsed. We didn't get back up there yesterday, so we put a new high in. So market structure is definitely looking like it's long. So I'm going to look at a test of there, and hopefully we get a reaction at that high. Downside, just shy of ADR and above that propulsion move. So that big buy there, if they retest that, look for some buyers in that level. But if you don't move, you don't move. There's nothing you can do. Get a little bit of movement on the DAX now, but what a choppy open. Look at that. 5, 10, 15, 20, 25, 30, 35. Took 40 minutes to break out this morning. You can do. It was crap. Morning, everybody else. Evil, can't wait to see how this new scorecard reacts to SMB Jordan's statements. So yeah, basically the scorecard I will have in there. I mean, it's SMB. I mean, like I said, don't trade the Swiss. Flip a coin. Fundamentals means nothing to the Swiss franc or the yen because they don't operate in the same way. Don't forget, fundamentals drive markets where fundamentals are the driver. Fundamentals are not the driver for the Swiss or the yen. They have never used interest rates in Japan for 20 years to control their currency. So fundamentals mean nothing. The Swiss is a safe haven. Yeah. So even if the Swiss was going bankrupt, if there's a war kicking off, everybody puts their money into the Swiss because it's got low interest rates and it's a safe haven. So fundamentals means nothing. All the other currencies move on fundamental bias. So, even though you can have a scorecard system based in the same way, the interest rate differentials on the yen, which is why the yen's been a carry trade for decades, have been negative. We've had negative interest rates in Japan for over 15 years. Yeah. So the interest rate differential has always been buy it, isn't it? You've always been buying against the yen because every other interest rate, even the Swiss, has been higher than the Japanese. And that's not changing. So therefore, nothing, the fact that they've now decided to change their interest rates instead of not change them doesn't mean that the fundamentals are any different. The differential on that is still 5.35. Yeah, you're going to get more money if you put it in the US dollar than you are if you put it in the yen. But because high interest rates are variable, if you want to put your money somewhere safe where you're going to get a guaranteed return, you stick it in the yen, you stick it in the Swiss, which is why when there's any problems in the world, the safe havens get pumped. So the new fundamental scorecard will just look at news and it will look at the differentials on news. So it'll be a case of if the CPI number changes on the Swiss, it will have the same impact. Yeah. And for a few weeks, it will have that impact. But that won't be a long-term thing. So the reason I want to break it down more is because at the moment, we are, in the past, you can always say if interest rate differentials are X, you should be long or short or whatever. There's always been a reason. This is why most people that follow any fundamentals concentrate on interest rate, inflation, GDP, and unemployment, because they are the big four that the markets use to gauge directional bias, which is what the COT report will always reflect whatever these fundamentals are doing. We've never been through a period where they're as important as they are. Since COVID, it's been a completely different story. It's been a massive rally, super fast, which we've never had before, followed by a complete freeze, which we've never had before, followed by what potentially now is going to be a drop like we've never had before. Yeah. So you kind of need to look at it on like we've seen with the Fed. Every week they change their mind. Every week, every news event changes their bias, their focus on what they need to do. So you don't need to be looking at these four, I think now. You need to be looking at what is driving into these. So interest rates are CPI, PMI, all the other interest rates affecting news events. You need to break all these down, because if the CPI goes up and the PMI goes up at the same time, you're not going to see it change necessarily in the market straight away. But if the PMI goes up by 1% more than expected, that is going to go up. So before that number comes out, they will buy into the CPI number. If we know what that is, we're using this at the moment only, but we need to be seeing what that is so that we know what is going to potentially happen to that. Same with unemployment claims. If unemployment claims go up 2 weeks on the trot, the next time you get non-farm payroll, you can be pretty damn sure that the unemployment rate is going to rise. What's the unemployment rate rising going to do to the US dollar? We can predict that, but we've got to keep an eye on this. If we've got a bullish one and a bullish one, fine. But if the differential is that as opposed to that, you need to give more weight to that, because that's definitely going to go up, isn't it? So it's just a case of trying to break down more into what's going to be moving the market in the future, but allowing us to have more of a weekly bias on it rather than a long. This is like COT. This is top down, bird's eye, 3,000 feet up. Yeah, their interest rates haven't changed, but that's got nothing to do with the future. Yeah, the fact that they've come out and said we might have to put them up again is more important than whether they changed it and what the number is, because the fact that they've said they have to put it up makes them bullish. We need a +1 somewhere to say last time in the statement it was we're going up. Yeah, so kind of got to be broken down more, I think. And that's what the banks do. You know, the banks' scorecarding systems have 50 to 100 variables, not 4. This is a super dumbed down version. But I think it's more important now than ever to pay more attention to all the little bits. You know, Bullock speaking. Yeah. So what's Bullock going to say? If Bullock comes out and says the CPI is not looking good and it means that we definitely are not going to change our interest rates this year, that should go into the scorecard. It's important because the market is going to listen to that and go, right, we don't want to be selling the Aussie, do we? So you may see a spike, but there's an opportunity on the retracement now to buy it. That sort of thing. But you're only going to see that if you're scorecarding it and you're looking at it on a daily basis rather than a big overview of fundamentals. So just a little bit more like the banks do. You know, when I built this, it was great. But I built it just as the interest rate rally stopped. Because the reason I built it was because I wanted to keep track of interest rate, inflation, and all the fundamentals. And just as I got it launched, they went, we're not changing it now. But, right, so it means nothing, does it? Because it's never changing. Which is why we started taking into account COT and retail sentiment. But these don't make enough difference. Yeah, all the little bits change the direction dramatically, don't they? On a week-by-week basis. That's why we see the market at the moment. We've seen the market doing this. You know, this price action that I keep talking about. Normal market structure is what we're used to. Yeah. What we're seeing is that. And the reason we're seeing that is because that was your PMI. That was your CPI. That was your interest rate decision. Yeah, the market is reacting only to news. The rest of the time, it's sitting waiting because it's too hit and miss. Because it's, we're just not in a normal market at the moment, are we? Not, this thing that we're in at the moment, this world that we're in at the moment, is very, very different to what it was, and the drivers are very, very different at the moment. And they're going to get, I think, more unstable as we get China, Brazil, and India, and as soon as these other currencies and economies start challenging more to the US, China specifically, obviously. If the US dollar becomes less of the world currency, again, we're going to have to adapt. You're going to need to look at different ways to try and forecast where price is going to go. But this is the thing as well with the crypto side of things, and the moment markets or businesses and banks make money using money. Yeah, this is what market maker desks are. You push and then you pull. The pull is the profit take. And that's what the markets have always done. It may be a case of they stop using these markets to become their profit-making machines, and they use other factors. AI may have a massive impact on that. It may be that we do not start doing the normal movements we used to do. Yeah, we don't push and pull to make profit. What we do is we use AI to make profit like this. Yeah, nothing we do now is going to work if that happens. We don't know what the future is going to hold. So you've got to adapt. And I think at the moment fundamentals are still the massive driver. You can see by this movement that we had here. Yeah, fear and greed still drives this market. Fear and greed is driven by fundamentals. Yeah, what goes on in the world is what drives the market. That proves it. So we need to be paying more attention to the micro element of it, I think. But at the end of the day, all fundamentals are exactly the same as this. Yeah, this little line on the chart is a moving average. Moving average is what most people use for directional bias. Whether you use a moving average or whether you use fundamentals, all it is a bias. A bias is where we think price is going to go over a period of time. How long it takes to get there, we're still never going to know. Yeah, just because you've got a bias long doesn't mean it can't come down for 4 days or 8 days. Yeah, bias on this is long at that point. It dropped for 4 days and it dropped for probably 8 to 10 days. Yeah, if you've got a long bias on it, you're the wrong way for over a week. Same with fundamentals. Aussie might be long, US might be short, so you should be buying the Aussie US. The US can have 4 good news events on the trot, which will drive that thing down for weeks. The bias is still long. Yeah, so it's only a very big top-down view, don't forget. Anything you do with fundamentals, with COT, all the data that you see fundamentally is very, very high up. Did you say the SIH EA can be used to trade Forex breakouts? Nope. Yes, you can. I don't know. It's all the SIHEA does is trade a range. So it uses time, doesn't it? So if you want to trade a breakout, you would set the time that you want to monitor for the range. It will draw the range and then it will take a breakout of the range. A lot of people have used the SIHEA for the London breakout strategy and the ORB as well, opening range breakout EA. A lot of people used ORB or do use ORB EA to trade London breakout. The ORB EA does the same thing as the SIH. It obviously just doesn't do hedging. It does stops instead. But yeah, you just have to set a time for your range. So if you're trading London breakout, again, this is why the strategy doesn't work. Nobody's ever proved me right. plenty of people will sell you a course on it, but nobody can show you a P&L of it consistently being profitable, can they? This is the thing. It's got to be discretionary. But the London breakout, most people will look at 8 o'clock in the morning as the open. But the market doesn't open at 8 o'clock in Forex. That's a bad example because that is 2 US pairs. Yeah, so there you go. Today, prime example, bang, 8 o'clock on the dot, market takes off. Yeah, but some would argue that the market took off 30 minutes before that. Some would argue that the market took off in Asia. So, you know, what do you choose as your range? Do you choose the entire Asian range? Yeah, if so, you haven't had a breakout yet today. Every day it's different. I've seen markets move at 10 o'clock in the morning, 11 o'clock in the morning. Sometimes they move at 6 o'clock in the morning. There's no open. The whole edge of the opening range breakout and the stock index hedge strategy is we know when the volume and volatility is coming. Today's a bad example. But normally the open is where the volume enters the market. The volume didn't enter today. The market's flat, dead. But most of the time you get the volume spike at the open. In Forex, there is no open. It's 24/5. It's open 24 hours a day, 5 days a week. It doesn't have an open. You have 3 sessions where the 3 banks pass the orders to each other. Yeah, they build a book, they pass it to London. They build a book, they pass it to New York. They build a book, they pass it back to Asia, New Zealand, Singapore. Yeah, it's an endless cycle. Stock market shuts and it opens. That's where your edge is. But you can use it if you want to, but you have to define a range. And the range is defined by time in ORB and SIH. Brian, who's not in here at the moment, but who's quite often in the New York session, he was trading breakouts of various different time frames. Some days they are fantastic, some days they're terrible. Yeah, like all markets. Yeah, you'll have days where it will just suddenly take off for the entire day. And you'll have days where it just grinds. You'll have days where it does absolutely nothing. You'll have days where it whipsaws, does nothing, and then New York takes off. There is no consistency. If there was consistency, we'd be millionaires. We're not. What's the commitment of traders about? It's basically it's all explained on the website, but it's the open interest for non-commercial participants in the Chicago Mercantile Exchange. So it's the futures market for non-commercials. So this is the positioning of non-commercial participants. So on the Australian dollar, the speculative commercial traders are short the Aussie at the moment. But COT is very, very much it says on here, this is not a timing tool. This is long-term view from speculators. So this is pension fund type speculators. So there's two main data types in the CME report, which is published every week, every Friday. Chicago Mercantile Exchange publish every single order position, long or short, and what type of trader has taken that. By trader, I mean which institution has taken it. Yeah. So there's 2 main types. You've got commercial and non-commercial. Commercial are typically hedge funds. Hedge funds do not give a monkeys on direction. Yeah, they couldn't care less. If they are long the Australian dollar, it's because someone in Australia has got a transaction they need hedged the opposite direction to secure their profit. Yeah, so they are going that way for no other reason than to secure a position. So it doesn't matter if the market goes up or the market goes down. The whole purpose of the trade is to stay stable. So we don't want to pay any attention to commercial traders because their positions do not give us any idea as to whether the market thinks it should be long or short. Non-commercial participants are banks and institutional traders that have a speculative position on, which is basically they are expecting and hoping that the market will go in a direction. And these are trades that will be entered to and exited, options and things like that, within a period of time to make money. So they're speculative trades and they are purely for profit purpose. So these non-commercial orders, the 58% of them short, are expecting the market to drop at some point within the next 1 to 3 months, and they will take their position off when they have the profit. So these give us a top-down quarterly perspective on where the market thinks it's going. Yeah. But like the CAD, for example, is a massive short at the moment. The US is a massive long at the moment. The problem with COT, and this is the downside to COT, is you are always on a 2-week delay. Yeah, because the COT report is released on a Friday afternoon after the market closes, and the data they publish is for that Wednesday to that Wednesday. So you are looking at every Friday, you're looking at what the positioning was 2 weeks ago. Yeah, 2 weeks ago, the interest rate on the Fed, from the Fed, was not going to change until 2025. Now we're potentially dropping the interest rates next week, and we're putting 1.25% drop in. In 2 weeks, that's changed. I would imagine you will see these numbers fluctuate on Friday. But when we come to Friday this week, we'll be looking at last week and a half or so's data. So it might not be till next Friday you see these change. So you cannot use this as a short-term directional tool. And this is just telling you what the market thought then. The market thinks something different now. Totally different now. Yeah, go and look at financial juice. The market is now factoring a 1.25% drop and a potential drop next week is what we've had come out in the last 2-3 days. Yeah, this data, useless. Yeah, which is why I pay a lot less attention to COT now than I used to, because in the past, pre-COVID, COT data was the holy grail for futures traders, because we knew that, yes, the US economy is good, it's strong, and everything's doing well, or, oh, the US economy is not good, it's, Right now, it's a case of this week it looks like it's good, now it looks like it's bad. Yesterday it looked good, but then 2 hours later he changed his mind. No. This doesn't make any sense now. Since COVID, the market is mental. It's completely different. The way it moves is different, and the way that market participants are looking at it is different. I think there's a lot shorter trades happening now than there used to be as well. So it's not useless. It's like I said, it's the holy grail. Yeah. If you go and ask any futures trader on the planet what they use for directional bias, none of them won't say COT. And if they don't say COT, they won't be trading profitably. Yeah. This is what the whole market uses. This is basically telling you it's not a kind of speculative indicator. In fact, 58% of market participants' orders in the market were short by large institutions and banks 2 weeks ago. Yeah. Do large institutions and banks make money? Yes. If they are short it, do you think you should be long or short? Yes, you should be short. It's fact. Yeah. That's the way that we used to look at this, and you should still look at it. But if you're taking a trade over the next 3 months, we don't. Intraday traders and short-term traders like us, we're not interested. This is for investors. But if 82% of the market is long on gold, right, you want to be long on gold. Yeah. So if you just press the buy button for 3 months on gold, the edge would play out. But intraday, it can go down for 3, 4, 5, 6 days on the trot, maybe 2 weeks on the trot. Could go down for a month. But it will be higher in 3 months' time than it was when it started. That's what you need to look at this. So think seagull. I'm not going to draw a seagull. There you go. There's his beak. That's a crap seagull. Got a tail as well. Seagull, yeah. Charts. That is where you are. No, actually, that's not right. Seagull, it's jumbo jet. It's 30,000 feet up. Yeah, it's your 200 moving average. It's your long term. It's this. Yeah, look at, I don't know, let's have a look at what euro is. So euro is 53%, pound is 75% long. So the bias on this, you'd have to say, is long pound, longer pound than euro. So your bias on the euro pound will be short, isn't it? Because there's more participants are longing the pound than they are the euro. So the euro pound will come down. Yeah. But it went absolutely nowhere for 2 months, and then we had a spike up. So if you were going, all right, the clock says I should be shorting this, for 2 months, you went, every time I short it, it stops me out. Every time I short it, it stops me out. Every time I short it, it stops me out. Every time I short it, it stops me out. Now it's bloody gone long. All right, screw cot, I'm going long. Bang, bang, bang. Was it right? Yes. It's a long-term view. The market will move it in the direction it needs to move it in, but it can do it in 3 or 4 weeks. Look at the yen. Yeah. Undone 1, 2, 3, 4, 5, 6 months worth of price action in a month. Cot bias shifted. When did it shift? Probably there. When did it action it? There. Yeah. So that's what it is. It's not, you can't use it as a timing tool. It's your super. Think moving averages on your chart. It's one above that. But no, just one thing. There's a million things you can use for directional bias. You can flip a coin. It's just got, you know, intraday, the way that we trade, all retail traders are trading, most of them are trading 5-minute, 15-minute. They're trading the chop, the nonsense, trying to figure out some kind of logical pattern on something that's completely irregular and it's never going to do the same thing 2 days on the trot. Half decent ones will be moving up to the hourly time frame to smooth all the crap out. Proper traders are trading hourly, 4 hourlies, and dailies. Yeah. Institutions are up here. Cot is up here. We're not here. We're down here. So cot bias is a lot less impactful to us. Just it's not something that you can really use as a retail trader. If you're an investor, yes, it's what you will be using. Think Warren Buffett's. 2 weeks old makes it pretty useless. Yeah, it's but it, you know, there's indicators that show you cot. I've done a very detailed analysis of cot. I had an indicator. I actually had to buy it. It's quite an expensive indicator as well, and it plotted from a database all cot data on the chart. I don't think I've got it, and I haven't got a subscription to it. If I did, it wouldn't work. But there is an indicator out there that does cot, and it plots it as an oscillator, another oscillator, showing you what the open interest is, and you can change it to all sorts of different cot data. The cot spreadsheet has 1 million columns, like 1 million columns. You only need 2 of them. But there's a number of ways of reading it, but I found absolutely no confluence intraday with cot data. I found no way to use it as an edge. So when the cot data dropped below a level, it was a case of you should start to go short. It would rally for days on end. And you'd be like, well, that's no use to me. But it would do what it said, yeah? If you were here on the daily chart and you were trading weekly ranges using positioning, which was 1.5, 2 ADR apart, and you were going to hold your positions for 2 to 3 months to make money, you wouldn't go far wrong with being in line with cot. But you'd have to have a serious wedge of cash to do that. And to be honest, you'd be much better just buying the S&P because that goes up all the time. Long term, you can't really not make money buying the S&P. Do that, it's easier. You haven't got to look at a chart every day either. It's just much easier to do. Right, that's all I've got for you today. I'll be back tomorrow afternoon for the New York session. We'll have a look at what's gone on in the news tomorrow. There's not a lot happening today, as I say. Overnight, you've got to worry about Aussie Bullock speaking. Very unlikely you'll get anything there that is going to hurt because it was all said in the rate statement and the RBA press conference. So Bullock's basically just reiterating what was said there. So unlikely that will move the market much tomorrow. New Zealand inflation expectations. This is red only because they may change their mind on it, but normally we know what that's going to be. So even though it's red news, it generally doesn't do an awful lot unless they give us some weird forecast. US dollar unemployment claims tomorrow afternoon is the only real big mover pre-market. Oh, no, sorry. And the CAD unemployment rate pre-market. Oh, that's Friday. Yeah. So yes, so tomorrow is the only one we've got is the unemployment claims pre-market. So again, this is what I'm saying about this new scorecard that I'm working on. If that comes out higher than expected, and then the next week, because it comes out weekly, it comes out higher than expected. The next time we get round to non-farm payroll, that number's going to come out higher than expected. We can use that if we know what that. So, you know, while on its own, it might do that. You'll probably find if it does that twice in a row, if you look at it over a longer period of time, that's what you're going to see happening. So it may or may not be any use, but I'm going to build it anyway. Sounds weird that the hedge funds drive the market in one direction just for existing customers for profit. No, the hedge funds don't do that. Hedge funds don't make money. A hedge fund's purpose is not profit. A hedge fund's purpose is security. Hedge funds are there. I'll cover it. So, for example, this is the example I usually use. I am a company in Japan. I am manufacturing electronics. And USA places an order with my company. And I am going to then invoice the USA when that transaction is completed, ship it, and then they will pay me, right? From order to payment could be 9 months to 12 months, okay? The cost of manufacturing, purchasing components, etc., 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 in January is going to be completely different in December when I get paid on that order. So what I will do is, if it costs me $2 million to buy, manufacture, and ship, I will place a hedge on the US dollar yen exchange rate equivalent to my value of my order in the opposite direction. So if the profit on it's a bit more complex than I'm explaining. I'm not explaining it very well. But whatever the profit I'm going to make on that is, I need to have a hedge on the market in case it's dropped by the profit I make, the US dollar yen exchange rate, by the time I get paid. Yeah. So I'm trying to think of another way to explain it. But that's basically what hedge funds do. Wheat is a good example. Farmers buy seed at a price. Yeah. They will then sell their completed crops at a price. If the weather means that they cannot sell, they need a hedge in the market on the wheat price, because the wheat price will go up if the supply of wheat is lower because weather's been bad. So when they buy their seed, they buy the wheat price. They hedge a futures contract on wheat, and that is done by a hedge fund. They will not make money on it, but what will happen is the hedge fund will adjust the price of their position as the forecast gets better and better and better. It's a little bit like spread betting on Betfair, yeah? when a football match starts, the odds might be 2-1. As the football match goes on and gets closer to 90 minutes, the odds of the team in front will keep going down. That is a hedge. Yeah. So if you bought it at one price and then it went the right way, you make money. If it goes the wrong way, you lose money. But if you hedged as the match went on, you would reduce the amount of money you lost. That's what hedge funds' purposes are. Speculative traders are buying a crap load of something and hoping and anticipating and speculating that it will go up to a different price at a different point in time. That is what we're interested in on COT, non-commercial speculative orders. Commercial orders tend to be hedges. That's probably a really bad explanation, but that's basically what it is. This is why people assume hedging is trading one currency up and down and locking in a loss, or that's not what hedging is. Hedge funds do not trade US dollar yen long and go, oh, it didn't work out, let's short it, we're going to lock in a loss. It's really complicated, but you don't need to know about it. Honestly, forget it, doesn't matter. One of those things you just are never going to need. Yeah. Hedge funds are irrelevant. Hedge funds make money on commission. Yeah. If a hedge fund basically says, I will hedge this position for you. As long as we keep your costs on the hedge down to this percentage, you will pay us X. Is that okay? Yes. Hedge funds make loads of money. But they don't make money because they get direction right. They don't give monkeys about direction. Banks, on the other hand, do. This is why they pay their analysts £60,000 to £100,000 a year as a starting salary to be an analyst. Because if you can tell the bank which way something is going to go, they will pay you a big amount of money. And this is what scorecarding is. Yeah, this is where this fundamental scorecard comes from, is basically what the banks do. The banks and institutions have a system in place that says if the fundamental says this is happening and this is happening and this is happening, we'll allocate a score to it. And that means that the currency should go up over a period of X. That is what a scorecard is. And this is what this bias is here. Because interest rates for the pound have not come down or are higher than the Canadian interest rates, we score it +1. The interest rates on both of those didn't change last time, so it's neutral. The inflation at the moment is coming down or is lower on the pound than it is on the CAD. So we give the pound a +1 for that. Yeah, the GDP is better for the pound, so we give it a +1. Unemployment is not as bad as Canadian, so we give it a +1. That gives us an overall positive stance on the pound against the Canadian dollar. The banks have 60 to 100 of these indicators. They're all indicators. That's all they are as well. So when and this is why we have change here. If the differential change on the pound, suddenly they drop their interest rates and the Canadians don't, that becomes a minus. So we knock one off of that. Basically, economics is a complicated thing. And unless you have been to university and studied economics, it's bloody hard work. At the end of the day, that thing goes up and down based on the volume of orders in the bank. Everything I've just said, if you want to pay attention to it and learn it, do it. But like I've said this morning, if the COT says short it, it can still go up for 4 weeks on the trot. Doesn't help you, does it? More complicated than they thought, this trading thing, isn't it? Right, I'll leave it there. Anything you need, let me know. I'll be in Telegram and Discord. Other than that, I'll be back tomorrow afternoon. Yeah, we'll see where everything goes. But at the moment, just waiting for some signals on stuff. And yeah, we'll go from there. All right, have a good day. Anything you need, let me know. Otherwise, I'll see you next time.